start with the geopolitics. I outlined it all on Monday. If people haven't watched it, you can go to the YouTube channel to find it, or on Real Vision, explaining the three outcomes. We're still awaiting. I said there was a 2-week window, and we're in that window. Is there going to be some sort of dirty, horrible compromise that everyone's a bit stinky-nosed at, but it appeases the markets, or is this going to get into something worse? We have to wait and see. So the markets have been thrashing around trying to digest news flow, which is always why I've said be careful of trading geopolitics. But there are more structural things going on that are interesting. Obviously, equities are still in a bear market. Whether they're trying to find a low or there's something bigger, we don't know yet. My thought process is it's probably more likely to be getting closer to a low. But if we start playing out the full recession card, which the yield curve doesn't yet suggest, then okay, that could be different. So I'm looking at that. I'm looking at the dollar. I'm looking at the bond market, looking at gold, looking at crypto. So there's a lot of things to look at.
Where do you see crypto going right now?
So in answer to right now, I don't know. The chart looks like it wants to go lower again and have another spike low. And that's been my view for a while. However, the crypto markets have not made a new low versus last year. And I think we've thrown 8% inflation, the market pricing in at 1.8 rate hikes, and a war, and you haven't made a new low. It's like, okay, that's telling us something. Now, maybe that can change, but I mark that down as interesting. I've got a lot of technical divergences, a lot of the on-chain activity is very interesting. So I'm still thinking that we've probably captured the downside in this 50% down bracket that we've been in with Bitcoin and ETH. So that's where I think we are. But I'd like to zoom out. So just like we did before, where are we before? So Brian, if you pick up the first chart, so I've talked about this before and just updated it for Global Macro Investor, my research service, which is crypto users versus the internet. What we did here, well, Remy did it for me, was we started at 5 million users each. When they both hit 5 million, we then start measuring. And what we found is that crypto has been significantly outperforming the internet in terms of adoption. We're way ahead of internet adoption. So if we just continue at a kind of slightly slower pace, we get to 5 billion users by the end of the decade. There's something called that. So Metcalfe's law is the network effects, but there's the other thing called Reed's law, and Reed's law is when you build network effects upon network effects, and you get true exponentiality. So if we're thinking here, we're building the foundation layer was the internet, then mobile data, 3G and all of that starts accelerating it, and broadband and all of those things, and then you add the internet of value on top. Of course it's more exponential by its very nature, and the fact that you can own part of the network makes it more attractive for everybody to be involved. So if we look at the next chart, I've got another chart of this, just zooming in a bit. So Brian, if we flip to the next one, so here's a couple of assumptions. So what you can see is in the first 6 years, the internet grew at 76% a year, or 78%. Crypto's been growing at 117%. So it's much faster growth. So we're at 300 million users now. At the same point, the internet was only at 119 million. So you can see the scale of how this happens. So if we assume that suddenly everything slows down in crypto adoption and we grow at the same speed the internet did over the next 4 years, so this is now from year 6 to year 10, we get to 500 million users. So 1.2 billion users. If we just assume the ratio lower, then we still get to, ridiculous numbers of 2 billion by 2026. And this is the one I'm pretty proud of. So I've been bleating on about Metcalfe's law, network effects, how to value these things. And it's very hard to do because Metcalfe's law is quite a complicated formula and you don't know what data to use. So I thought, I wonder if I can approximate it. And Remy and I went through all of the data for writing Global Macro Investor. And what we built was a network value model. And we tried a number of different things and found out you can explain every crypto network by 2 simple things. The volume traded on a daily basis, monthly basis, and the number of active wallets over that period. Once you map that out, it's one multiplied by the other, the charts exactly fit that of Bitcoin. So we thought, okay, this is interesting. So basically the network is the amount of activity on the network, not in number of transactions, but in value that gets exchanged every day, and the number of people exchanging value. So if you think of a network, if you've got one participant who's doing $1 billion, it's not very valuable. But if you've got $1 billion being done by 20 people, you've now got a network. So it kind of makes sense. So I wanted to then test it against Ethereum. So if we look at the next chart, it works perfectly for Ethereum as well. I don't know, we've lost Brian now. Brian?
I think the charts are just lagged. There we go.
There we go. So that's Ethereum. So really interesting. And it also works for XRP, which is weird. You wouldn't imagine it would, but XRP works exactly the same. Everything in a network is basically the volume of transactions in dollar terms or value terms and the number of people using it. That's it. And that, I think, is a big breakthrough for the space. I don't want to pat myself on the back. Now, doesn't mean I can yet forecast it using this, but I can show what drives the value of a network. And I'm working on other models now to start having forward-looking indicators to understand, okay, what's really going on. Look, there's some big picture things. I covered gold in the update that I did, which is right now you don't know who owns what assets. You don't own anything because the government's taken it away from you, which is we've kind of known, but it's been writ large in the last few weeks. And I think, even though gold is coming off because it had a good squeeze higher, I think we're going to see more action there. The one to watch, I think, is the dollar. The dollar is really important, and the dollar is very strong. I do expect the central banks to try and slow it down at some point, but the dollar going up basically creates credit issues for the global economy. We've already seen places like Nigeria running short of dollars. We're seeing it in Sri Lanka. We're seeing it in the periphery. It always happens in the periphery first and then comes back. So there is liquidity issues further out in the system. So just keep an eye on the dollar. The more the dollar goes up, the more liquidity issues you're likely to face, and the world struggles a bit. So just keep your eye on that.
What are your thoughts right now on the bond market?
So I have been following something called the chart of truth, which is the long-term trend in 10-year bond yields. And it has a couple of times got to 2 standard deviations overbought. I don't know if Brian's showing the chart now, but 2 standard deviations overbought. But generally, it gets this kind of zone between 1 and 2 standard deviations overbought, and it reverses. So, okay, we should be on alert for something changing in bond yields. Why? Everyone's screaming inflation, but I think of the inflation at 8% as a massive tightening of monetary conditions, because neither corporations nor people can offset it with increase in earnings or cost rises, price rises. So what you've got is a tightening of monetary conditions, particularly on lower and middle income households, because the earnings gap is massive between wage growth and the inflation numbers. And that tends to slow growth. And we're seeing forward-looking indicators suggest that growth is slowing down quite fast. And that will play out not immediately, but in the next 6 months. So I'm looking at this thinking, could everybody be kind of wrong at bonds? I mean, the last time it got to 2 standard deviations was when Jeff Gundlach was talking about yields going to 6%. They didn't. But then something else is going on in the bond market, which is the yield curve. Now, everyone's talked about this, but this is a really nice chart that shows the yield curve. Now, it goes up and down. It goes 300 basis points on the upside and maybe negative 50 on the downside. And usually when you get to negative, maybe a year later, you get a recession. So what's weird this time around, it's kind of peaked really early, which plays into the argument that I'm having that monetary conditions are actually, the inflation is actually essentially like rising interest rates 200 basis points already. So once the Fed starts to rise, on the next chart, you can see what happens. So Brian, if you flip to the next chart, so these are the last 2 rate rises, and the yield curve is in orange. The yield curve flattens as soon as they start rising. So we're currently today 25 basis points from a yield curve going to zero. So I can't see how you can get interest rates to rise more than 50 or 75 basis points before you've actually created a recession.